Let's talk about rebalancing issues, but first let's define rebalancing for the sake of this video. Rebalancing is adjusting portfolio weights to more closely align with the strategic asset allocation. So naturally, the weights of assets in the portfolio are going to shift as the prices fluctuate over time. So one thing we need to keep in mind is that this rebalancing is often going to have this effect of selling winners and buying losers, right? Because as the stocks or certain asset classes in the portfolio rise in price, then they hold too much weight rather than the amount that we should target for them to hold. So then we have to sell them. So we're selling the winners, buying the losers. This is countercyclical. Most people have the bias that they're not going to take money out of things that are doing well and put it in things doing badly. However, this can benefit from mean reversion, because if you think that maybe two assets should roughly be valued similarly and one goes up in price and then one goes down in price, maybe you want to sell that one and buy this one and hope that maybe they come back to similar value over time. There's two main ways that we can rebalance. The first is calendar rebalancing, which basically means that we're going to be rebalancing the portfolio to target weights on a periodic basis, whether it's monthly, quarterly, semi-annually, or annually. The problem with this is, let's say we pick semi-annually and we rebalance and then some crazy stuff happens 1 month later. Now for 5 months, the portfolio allocation is going to be all out of whack with what we said for the strategic asset allocation. Now, a rebalancing method that aims to fix the issues that we just talked about with the calendar rebalancing is the percent range rebalancing, which is setting rebalancing thresholds or trigger points stated as a percentage of portfolio's value around target values, and this results in a rebalancing range. So imagine we say our allocation to equities in our portfolio, we want to be 50%, but we could go 10% below that or 10% above that. So we could go all the way down to 40% or all the way up to 60%. Now we might start at this point, and then let's say equities really increase in value relative to the other asset classes. All of a sudden we have 61% or something. Now we need to, at that point, rebalance back to the target. But if equities went all the way up to 59%, then we might just leave it the way that it is. And only once it goes beyond that do we start rebalancing. So this has the benefit of basically being more dynamic, because we can keep our portfolio closer to our target when large movements happen. It doesn't have to be at a certain time interval like the calendar rebalancing, but this also requires us to do more monitoring.
On the bottom of the screen here, I've drew basically an example using equities as a percentage of the portfolio. And now an example of a narrower corridor. It could be this top one where we have this target of, let's say, 50%, and then we allow it to go 5% in either direction. And so that total corridor width is 10%, right? And if it goes out above 55% or below 45%, we're going to rebalance. Whereas a wider corridor example would be that our lower bound is 40% and our higher bound is 60%, which means that our overall corridor width would be 20%. So this would be an example of a wider corridor where we let our asset classes deviate more from their target. Now we can go through each one of these 4 factors and talk about would it lead to a wider, narrower, optimal corridor. So the first one is higher transaction costs, and this would lead to us desiring a wider, optimal corridor. Now, why is that? Well, with higher transaction costs, that means that when we trade, we have to pay more money to the broker dealer to get those trades done. So with a narrower corridor, it would be more likely that we get outside of these bounds in either direction, and more likely that we have to do more trades, which would cost us more money. This would be a higher hurdle rate. So with a wider corridor, we have trade less often, which means we incur less of these high transaction costs. Now the second factor is a higher risk tolerance, which would lead us to desiring a wider optimal corridor. Now, why is that? Well, when you have a higher risk tolerance, you can tolerate deviations from your target mean better. So you don't mind having wilder or more volatile deviations from this target because your risk tolerance is actually higher. Now, and the next factor is higher correlation with the overall portfolio. So when the assets within the portfolio have higher correlation to one another, that means that when one goes up, another will go up and they'll move in the same direction, which means that they won't really deviate from these targets as much because all the assets are moving in the same direction, which means that you can afford to have a wider optimal corridor because it's less likely that there will be deviations from the target and it'll breach the corridors. And then finally, higher volatility of the portfolio leads you to prefer a narrower optimal corridor. And the reason for that is because if you have higher volatility, you're going to have wider deviations. So it's safer to have a tighter or narrower corridor to account for these further deviations. The video you just watched is a part of UWorld's comprehensive CFA programs. Get 25% off any of these products using the promo code Ryan25 and the link in the description or the pinned comment. Thank you for watching.